How's it going, everybody? Thank you for joining today. We're excited to be here. Myself, Josh Lurie, principal here at F Street, and Nick Young, principal at F Street. We're going to be talking today about a new exciting industrial acquisition that we'll be closing on in December. We're already 65% raised and excited to talk a little bit about it today. For those of you who haven't joined, as you know, F Street, F Street is a real estate investment company. We're focused in the alternative investment space in real estate, specifically in the industrial and multifamily asset categories, both in the acquisition and development in both categories. So a little bit about us, already introduced us. We're a small and mighty team here. You can see our team here, vertically integrated, work with a lot of great project partners and third parties, but we've got a great team here and proud of what we're doing. Just highlighting our industrial portfolio. Currently, we have about 20 industrial assets in our portfolio that we're managing, just shy of 5 million square feet. We have just shy of 300 million in assets under management in the industrial category, about 750 total across the portfolio right now, in about 10 to 15 states. So I'm excited about the growth here at F Street and proud of our partnerships with every one of our investors here.
So today we want to talk specifically about F Street Bear Creek. We just released this deal yesterday to our network and released it on the website, fstreet.com. So if anyone wants to view it there, you can simultaneously look at the investment packet and subscription documents. We're really excited about this opportunity. We've been working on it. Actually, it's another one of those deals. We've actually been watching this one for almost a year now. We really like the deal because it's actually owned by a seller we've worked with in the past. And part of the reason we started to move forward with the deal was a new extension with the tenant. One of the major tenants being another Fortune 250 company in General Mills. And that's part of the reasons we love this is talking about our buy box. We've talked through our buy box on prior roundtables, prior webinars on what we search for on industrial acquisitions. And really it's, again, for us, finding value. We're not typically buying class A plus newer builds. We're buying buildings where there's yield, there's value, there's great basis. First and foremost, this building we're buying at $27.50 a square foot, which is a third of what replacement costs would be. Grid credit tenant. I mean, General Mills, Fortune 250 company, 50 plus billion a year in revenue. General Mills been in business 169 years. Talk about a group that's going to continue to produce and why this is so mission critical for them. We'll talk a little bit more. We have almost 7 years left on the lease, but there's still upside. I mean, we still have ways we can convert this lease because it is a modified gross lease. So it's not where the tenant pays 100%, but we've obviously built this in for our investor model and we'll go through that a little more in depth. But again, quality building. Going through the quality of this building specifically, it's a newer building. First part of the building, the south portion, and I'll show you here, the south part of the building's split right here. This portion was built, as we talked about, in 2002. And then the second portion, the 250,000 square feet here, was built in 2012. So just kind of going through their continued need for this space and the continued growing, being immediately adjacent to their manufacturing facility. And we'll show you a picture of that in a minute here on their manufacturing facility being just in this area here. Going more specifically and kind of talking through it, why invest? Why do we love this deal? Again, Fortune 250 tenant. I mean, we technically have two tenants with Nextran, actually, that we talk about here, occupies this building. Nextran is a Mack truck repair center that literally repairs all of the trucks that I believe it's 1,800 truckloads that go into this site a day. So, or 18,000 annually. There we go. That's one of the reasons why we love this site. And a long-term lease, like we talked about, 78 months left on the current lease by the time we acquire this property in mid-December. Low cost basis we talked about, favorable loan terms. We already have a lender set up. We already have a signed term sheet we're working through with a lender. We've worked through this program before, knowing where debt is and where it's going to line up. We're going to fall into mid to low fives. So we've really built this out, are in a really good spot. And talking about mission critical, this building itself is right next to the plant and accounts for 13% of General Mills revenue. So what this plant produces very specifically is Progresso soup. It's the sole Progresso soup maker in the United States, which is the second largest soup produced in the United States behind Campbell's. Old El Paso Tacos. And Old El Paso Tacos is the largest hard shell taco brand in the U.S. Their spices. Nature Valley bars are also produced here, and adjacent, as well as Little Debbie's.
Yeah. So overall, tenant profile, been in business a long time. We seek this out. This is a mission critical facility. They're manufacturing and distributing right in this location. Part of the reason why they love the location is due to the labor pool, right?
Right.
So the fundamentals work really well. It's a newer asset. We've got a great programmatic relationship with our lender, as Nick highlighted, and we're really excited to execute on the transaction and close in December.
Yeah, absolutely. So love it. Again, talking about the tenant highlights, I went through it before. I mean, General Mills, iconic brands being made specifically across the street here and being stored here. How this building actually works when we visited it is the south side of the building, which we showed, has the actually package of materials. So they take the materials from that side of the building and they bring it into the manufacturing facility across the street, fill those, bring those to the north side of the building, and then they're taking those and distributing them throughout the United States. So when it comes to mission critical, you can't be more needed than this annex building that they have a very low release rate too. And that's one of the benefits we see in this is we can increase that. I mean, as they have renewals, as they're never leaving, or we hope, it's mission critical until it isn't. But when it comes to being their largest manufacturing facility in the US, behind their Cedar Rapids, which is creating their flour, the odds of them leaving are very small. And that's the beauty is how critical they are also to the city of Hannibal. One of the reasons we didn't name it F Street Hannibal LLC. I mean, I think we all know why we wouldn't go that route. But they also recently invested, added 35 jobs and invested 50 million into facility in 2024. And that's really as they expanded the Old El Paso line and expanded their manufacturing north. And then again, Nextran, we just talked about, they're the largest Mack trucking repair company in the US. That's kind of how this deal came together, is the seller actually owns a trucking company, had sold off to Nextran, this center specifically, and he had built this building for them in 2022 and expanded in 2012. Crazy, originally on a handshake. So that's always one of the craziest things is how these things come together and how this really deal came to fruition for General Mills. Location specifically, we talked a little bit on here. I'll go specifically. So this is General Mills' main manufacturing facility right here. And then this is the secondary manufacturing facility. They just expanded the Old El Paso. And this is our building. So, I mean, you can see this is the direct truck routes. They go here and here. So when it comes to being mission critical for their manufacturing facility, this is it. But again, why we love this building and what we'll talk about more is, one, this deal provides, and we'll talk about a great cash flow. But the risk even is we still love this location and why it's critical for General Mills, or for us in the possibility of a backfill. If we had to backfill this space and we had some concerns about backfilling it, it's in a great location. It's basically on the Chicago to Kansas City kind of throughway, the highway. So you're Highway 72. And then you got the direct line to Kansas City. So talking about time, 4.5 to Chicago, 3.25 to Kansas City, and 1.75 to St. Louis. So really close to all these cities, and that's a single truck drive. So that's really critical for when you have a manufacturing or a logistics center, if we ever needed to backfill this, or why General Mills is going to stay there long term.
Right. And just as a brief summary before we get into the investment highlights, I think Nick brought up a lot of really excellent points. But as part of our F Street and overall risk mitigation strategy, when you have a great tenant, mission critical facility with a great labor pool and a great location, we have 7 years of term just shy of that in their existing lease, right? So as we have great cash flow that we're producing to the investors day one, right? Through 2032, plus they have 2 5-year options to extend. We also now have the opportunity to pay down debt, right? Mitigate the risk, reduce the debt over that 7-year period while the tenant reduces that debt, continue to build equity in the asset in addition to the cash flow that we're going to be talking about a little bit here. We really feel good about in terms of overall deal package, risk mitigation. And then when you add in the debt and the execution there, feel really good about the overall thesis. So
we love this opportunity. And again, I know we have some questions. If you have questions throughout, we're happy to take them as we go in, if we go to back specific slides. Good question. So the question was very specifically, how much essentially would our debt or how much would the equity pay down during the current term of the lease. We'll actually go through that in a slide or two here. We talk about that very specific on essentially cash flow through the current lease term, which will go through year 7. So let's actually address that in a minute here as we go through and get to that page.
And we're also we're happy to show you what your 100 grand example would look like or overall deal would look like in an Excel file that would show you that after the call as well to really boil down. And we're happy to hop on a call to kind of walk through that with you as well. Yeah, for sure.
Yeah, great question.
Yeah. You want to repeat the question?
Yeah, the question was specifically if it's not a net lease, what is the landlord responsible for? And then the second portion of the question is what are we doing to prevent capital calls or if we have large CapEx expenses?
Yeah, I'll take the latter part first. So initially in our sources and uses, which we'll also go through a little bit, we're reserving dollars up front, $500,000 in reserves up front to address some initial items that we've identified, specifically the parking lot, to make sure that that's up and running as that's a landlord responsibility. And then through cash flow, which we'll also talk about, we're going to be reserving a certain piece prior to distributions to build up additional reserve over time to make sure that we're in a good spot in 7 years from now, which is just prudent cash management.
And then specifically landlord responsibility. So we have 2 leases. So General Mills takes of it, they take 462,000 square feet. General Mills specific lease, landlord is responsible for insurance, real estate taxes, and then essentially large capital expense repairs, which is the roof, structure, and parking lot. Tenant is responsible for utilities, general R&M, routine maintenance for the facility, HVAC. So we've accounted for all of those in our net operating income. So we've already put those together. We've specifically called out what our real estate taxes are expected to be after a new sale, what our insurance costs are going to be. And so those are already built out into our NOI. We also have built into that fact, which Josh talked about for significant repairs. We have 500 grand we're putting up front just into reserves. Again, parking lot, we've already done the property condition assessment. So we have a really good idea of what our capital expenses are going to be over the next 10 plus years. So there's very minimal short term. We do anticipate likely coating the roof sometime between year 5 and 10. That's a few $100,000, probably about $2 a square foot on half the roof. So we're talking $400,000 or so. But we're going to be saving, and we'll talk about it more, about $75,000 to $100,000 a year in reserves. On top of, we've already built in what our landlord routine maintenance is, which is built into what we expect over the next 7 years.
For sure. And just to be clear, great point. Just to be clear, our cash flow projections are net of all these items. So we're taking into account all these different expense and landlord responsibilities before we're projecting and articulating, hey, this is what we expect for the equity that we're raising and what the returns are going to be.
And we are being very conservative on it. So the beauty is if we don't have to expend those repairs, or if we push the roof coating because the roof is actually in really good shape, or the parking lot is in really good shape, and we push those off, or I wouldn't say push off, or don't need to do those, that is money that just stays in the deal and eventually gets returned to investors.
Right. And that's part of, in terms of working with our asset manager and our general ownership team, we're constantly monitoring this asset, all of our assets, and doing routine maintenance checks and things like that to make sure that we're mitigating the risk of having that large repair, that large capital item. But at the end of the day, we know that we have to build in for that because eventually we're going to have to spend money to account for these capital items.
Yeah. So yeah, the question is why real estate taxes aren't an issue, or talk about how they'd come up or are an issue. So specifically for real estate taxes and how we've accounted for them is, looking at how, when you buy a new property, how the state of Missouri will reassess the property after a sale. Because we are going to be acquiring this, there's going to be a recorded deed with F Street Bear Creek LLC. So there will be a sale and a sale transaction. So what we've accounted for on our net operating income is any changes in real estate taxes and increases based on our new sale price. So that's how we're allocating for it. I have a lot of experience, and we typically engage external counsel as well on, if we need to appeal real estate taxes to what they should fairly be done. And we've accounted for that at least at this point.
Yeah. So I guess That's the first piece of it. The second piece is the rent, which is we are assuming a lease, right? When we close on the transaction, and the lease is the lease right now, right? So we have the built-in escalators in the lease right now, which we kind of view as separate from, the first part of the question. So one's a revenue item and one, really an expense item in taxes, which we've already accounted for and built in our model going forward once we purchase the property in December. Is that any follow-up questions to that? Okay.
Perfect. Yeah, just follow.
Okay. Okay, we're going to continue to go through the presentation.
Okay.
Sounds great, Peter. Just a brief page on the investment highlights, which we always do here. Here we can see that we're buying this for $13 million. As Nick mentioned, we have stayed close to this property over a long period of time and feel really good about our basis here and negotiating it to a really comfortable spot. We're buying this at an in-place 9.08 cap rate. We've already kind of talked about the scenarios. Sorry, not the scenarios, but the base scenario assumption with the tenants remaining in the lease and extending with no modification. And then we talked a little bit about our debt terms and how this is a multi-tenant deal, but understanding that General Mills makes up the 95% plus of the rent roll.
Yeah, specifically with the debt, kind of like talking about here, kind of the interest rate we've already talked about. The term of the debt we're doing is we're going to fix it for the term of, so we already have the bank lined up. We'll be fixing it for sometime between 60 and 78 months into a swap product with our current bank. And this is the rate we already really have from the term sheet.
Right. And that strategy is really a result of the prime term lease, as we talked about with General Mills going through May of 2032, right? So just kind of, building in and fixing our cash flow with our debt, understanding that and putting that full package together, and then giving some optionality at the end of that product.
Right.
So
and then, structuring where so that right now the loan is going to be structured of the first 12 months are going to be interest only, and then it'll amortize over 24 years, starting in year 2. Correct.
A little bit about just high level. This deal pays a 7% preferred return to the Class A investors, the equity, and then 100% of excess distributions, which we'll talk a little bit about in the next slide. 100% of that is paid back to the investors until they have all their capital back before there's a split between Class A equity investors and Class B F Street. So just a high level, we always run through our capital stack and fully disclose our sources and uses of capital. Our sources are pretty simple, right? It's debt, which we've talked about from our lender, and then equity. So we're raising $4.25 million into the deal. About 65% is already raised. So we're working through the final equity raise, which we're talking today about. And then as you can see, 90% plus of the uses of funds or sources are covering the acquisition cost. We've talked a little bit about the reserves. There's always some soft costs here, which we itemize here to get to the total budget of $14 million. And then just a high level timeline. Clearly, it's open for investment right now. All investor funds are due by December 12th, and for an anticipated closing December 18th. Monthly distributions will commence January 30th, right? 2026.
Specifically, the base case investment scenario. So we've really run a few scenarios, and Josh and I kind of walk through these, and we'll kind of talk the alternative scenarios. Really, we just look at this on multiple ways. Again, we love the quality of the asset. We like the site itself. I think General Mills is going to be a long-term player here with their reinvestment. There was a really quick question about why General Mills didn't buy the facility. They did have a right to do it under the lease. We don't know the specific reason. They did just not execute that option. We have that waiver from them. We've seen a lot of corporations right now. I mean, their stock is slightly depressed at this time, so that might have been a function of it, but we don't want to speculate on it. But I know in corporate right now, it has not been they have not explored owning these assets recently. That's what we've seen from large corporations recently. So really the base case scenario, like I said, we have seven years left on the lease. We look at it as, we're looking at a 13.24% projected year one cash flow because we're going to be on that IO loan. With that, essentially we're going to be distributing an excess amount of cash. We'll look at this as we're going to run it because we're going to be fixed from 60 to 78 months, so just between 5 and 7 years. That's where we'll look at essentially distributing additional cash flow. And here's the question earlier about, how much of my equity will be returned at this time, how much is going to be left. So here's kind of just running through this is the investor packet, and anybody has additional questions about like a specific investment amount as well, based on our current debt terms. So we'd be returning capital. So this would be distributions paid, and then this would be return of capital. So this is how much capital would be returned between year one and six.
So about $21,000 on a $100,000 investment would be returned, in addition to, as you can see, the preferred return paid of 7% on the deal.
Right. Exactly. So if there's any more specific questions, this is the base case scenario. We look at it as, if they extend, that's, what we think is the most likely outcome. That's we'd refinance the loan, like to be able to have the cash. We're projecting having vastly more than the cash to return 100% of the investor equity in year 7. So between year 6 and year 7 when they'd execute. And at that point, investors would have 100% of their money back plus their 7% preferred return. And even after having their money back, this is the mailbox money trees we talk about, where you'll still be getting on a $100,000 investment, you'd still be getting over $5,000 annually with 100% of your money and your preferred return back.
And I think one important, in just kind of a peek behind the curtain and how we get to these numbers, right? We're not just putting, hey, we believe we can return it. We're looking at, if in this base case scenario, General Mills extends their lease, right? They exercise their first of their 2 5-year renewal options, and we look at that cash flow, right? And then we project, we understand what banks are looking for in terms of debt service coverage ratio based on our new net operating income, right? So based on ensuring a conservative debt service coverage ratio, we're able to then get to a proceeds amount and an interest rate projection amount that allows us to still recapitalize the deal, allowing us to return the equity, but still maintaining proper debt service coverage ratio above 1.3, right? And then being able to put a little bit more debt on that asset to allow us to accomplish that recapitalization to provide liquidity back to the investors, while, as Nick mentioned, still maintain a healthy cash flow going forward for the next 5 years of General Mills' term, which is, we spent a lot of time doing sensitivity analysis on debt, understanding, the challenge, right, is we don't have the crystal ball. We don't know exactly where interest rates are going to be. So we run through a lot of different analysis, right, in 7 years from now, what it would look like potentially. So this is an estimate. We feel comfortable here, but keep in mind,
it could be even more.
It could be more if rates are lower. It could be a little less if rates go higher in 7 years from now.
Yeah,
so
we're still using a very conservative, I believe, we're using like almost a 6% refinance rate just to be very conservative. It's just what they are today. And just alternative scenarios, what we talked about, again, we like the asset originally, the low basis, good location, great quality building. We talked about lease conversion. If we move them to a triple net, even if we keep their lease right now they're paying the same amount, but we move to triple net, that increases our value because it increases the buyer pool. One of the reasons we love this asset is, we're willing to take on that modified gross lease because we can see pushing a lot of value in it. So that would, for instance, allow us to maybe sell at a lower cap rate and, have a larger IRR in a shorter term period when they extend that lease. The other one is we backfill. I mentioned earlier, if we need to backfill the building, we're vastly below market rents here. General Mills is paying $3.25 a square foot. We were thinking low 4s. If you get south of St. Louis, on a newer or even a Class B building like this, you're $6+ a square foot. So we can undercut the market. So those are just some of the backfill scenarios we've talked about. There we go. Okay. So I guess we'll open it up to questions specifically. Yeah. If there are any other questions as well, we're happy to answer them. I know we're kind of getting close to the end of our time here. Happy to go through them.
Yeah. The question here is regarding IRRs, internal rate of return metric, and our projections here. So it's a great question. We're always, we don't look at internal rate of return in a vacuum here. It's an important metric that we use when we're looking at cash on cash. We're looking at a lot of different metrics, equity multiple, things like that. We view this as maybe a longer term hold and a strong cash flow out of the gates with a great tenant in a mission critical facility, where we have to forecast different sale opportunities, but that sale event is because it's a time sensitive metric. The sale or the refinance in what year that happens here is heavily influences that IRR, right? which can be which is good to take into account,
Right.
but it can be misleading, as Nick mentioned, because of the basis we bought it at. We're able to produce in year one 13% cash on cash due to the IO nature, and then over the first 6.5, 7 years of the term, we're able to produce about a 10% cash on cash return, right? So we're viewing this less so and putting less emphasis and weight on the IRR metric, just because we love the cash flow, we love the asset, and we love the risk mitigation strategy of paying down debt and reducing our backflow risk and having a real ability to strike deals if General Mills exits with a much reduced basis over 7 years, paying down that debt, and being able to backfill this.
Right. I think it's a risk mitigation, or just it's risk. What risk do we want to take? I mean, we talk about, so we closed on F Street 92 Access Apartments, closing the construction loan yesterday. So if there's any interest on that project, happy to answer if you want to reach out direct. But that one, we do have a higher IRR. I mean, we were in the 20s there, but that's a ground up multifamily deal. I mean, there's a 24 to 36 month period where there is no cash flow. And it's, we'll call it on a higher risk profile with a higher returns, but, still a great asset we love versus F Street Bear Creek and the Hannibal, Missouri project. We have guaranteed cash flow from General Mills in year one. I mean, a Fortune 250 tenant, essentially paying your rent versus an apartment that hasn't delivered for 24 months.
For sure.
It's always about, the push and the pull on, where you want to go. Here, that's what we love is, you're at over a 10% cash on cash for the first 7 years during that lease term. And, you're playing on a renewal. So the IRR is less of a function on this deal, but it is a function because it's a long-term hold potentially, or like I said, in alternative scenarios, maybe a shorter term hold, but a great functional asset and a great lease, and it really hits all those items we love on why invest.
Yeah, it's a good summary, Nick.
Yeah.
Absolutely. The question is about the appreciating value of the asset, the buildup of equity, and then ultimately the depreciation benefits. So we always get a cost segregation study, a benefit study, which we've received from a third party Whipley. You can see, if you go to the next slide,
there we go.
the benefit study, which is very accurate to what the ultimate asset will produce. Number one, this asset will be placed in service in 2025. So the benefit of the depreciation in 2025, you can see here, based on the benefit study, for every $100,000 invested, produces about 20 to 30,000 of estimated passive losses for this specific transaction. So here it says our preliminary benefit study shows an additional deduction of 1.961 million in year one, and that's what that translates into.
Yeah, if anybody has specific questions about like how it affects them, because as a passive loss in year one, in the year 2025 here, if you have some passive gains this year, we're happy to go with that individually. You can check it out for myself.
Absolutely.
Great question. So the question is how is F Street getting this at such a low basis? So that's a great question. I mean, this is our relationships with brokers, actual relationship with the seller. We've actually bought a building from this seller before. F Street Fort Madison LLC. We closed in early 2025. So we built up that relationship. As mentioned, we've been tracking this building for almost coming on a year now. Because prior, General Mills actually had a short-term lease left. They only had a few years left on their lease earlier this year, and we didn't see the value in it. There wasn't that upside in it. They wanted a higher purchase price, and they were asking the high 14 million range. But with this new extension and getting the price down to 13, it shows not only General Mills' commitment to the facility, but the basis coming in lower, that this is what the seller was willing to sell it for. And for us, that's where we see significant value. So that was really like how we got it. We acted right away. As soon as we heard about the lease extension and we had our price, this is the price, they knew we're a good buyer. They know we're a buyer that's going to close. They've transacted with us before. So we've seen that before on multiple transactions where F Street's coming in, we know them, they're reliable, and because they're reliable, we're going to take F Street's offer, which might be a little bit lower, which is better for our investors, but we know their ability to close.
Yeah, I think the certainty of execution is important for a lot of the sellers. They're not looking to necessarily scrape every penny or $100,000 off the deal. So we're able to transact quickly, communicate efficiently, and they know that based on the reputation that we can close at the basis that we're comfortable with, and they know that we're not going to retrade, right? So we've already done a lot of the diligence. We've done the site visit. We got really comfortable. We've built in our reserves as we've kind of talked about, and they know that they have a great buyer at a basis that we're comfortable with, and we're not going to chase these opportunities and pay a price that obviously the seller would like, but we're not comfortable paying. Correct. Yeah, absolutely. And just to reiterate that this asset will close in this year. It
Yep.
will be placed in service this year, and the 20 to 30,000 of passive losses, which I explained per every $100,000 investor per the benefit study, will happen in 2025, which you will see on your K1.
Yeah. So if anybody else has additional questions, you can reach directly to Josh or I or anyone on the F Street team. Our emails, nick@fstreet.com, josh@fstreet.com. A lot of you have interacted with our team before. We are already 64% raised on this deal. Like I said, it's filling very quickly. So if there's interest, please reach out right away. Otherwise, visit fstreet.com. If you have any questions, please feel to reach out. And thank you again for joining us today.
Yeah, appreciate everyone joining today. Thank you for taking time out of your day. Have a great rest of your week.